Good morning. Hope you're all doing well. First, I wanted to quickly express to you my very stern concern that many of you are, at least 4 of you, are not following the instructions. I have explicitly said that you need to check your emails at least once a day, and every Tuesday morning, at least 1 hour before class. And I'm getting the reports that at least 4 of you are not checking your emails regularly. Now look, I've been teaching for 25 years. I've taught over 3,000 students. I've failed literally 3 people. So less than 0.1% of students I have failed. And even those whom I have failed have been only because they have not made the minimal effort to pass a course, especially a graduate course at a top university. All right, so I don't want to fail anybody. I really don't. But if you are not willing to put in the minimal effort, if you're not willing to put in the absolutely minimal effort, including checking your email at least once a day, and every day, every Tuesday morning, at least an hour before each class, then really there is no point in your continuing with this course. You really should do yourself and your parents a favor by dropping out. Because if you are not following those instructions, checking your email once a day, at least, and every Tuesday, at least an hour before each class. And also, in addition, I have posted some instructions on discussion board in Blackboard. And you are absolutely required to do all that. If you don't do those minimal efforts, then you will get 0 on class participation points and you will fail the course. Okay, I failed 2 people last semester at Hopkins. And the only reason they failed is because they did not put in any effort. I will work very hard with each and every one of you to make sure you do well. But if you are not willing to put in the work, there's not much I can do. And so I don't know how else to say this. I will forward your names to the relevant counselors and the directors of the programs for them to take action and give you the sternest warnings possible. But I'm not going to treat you like kids, because you're not. You really should be responsible adults. So please consider yourself warned. For those of you who are checking your emails, and I posted a bunch of questions on, well, one question, but many subparts on the Blackboard discussion board. Well done. Keep up the good work. I am extremely responsive. I will work with every single one of you to make you, to really have you succeed. And we'll take it from there. So let's have today's session as we have planned, Tuesday morning, US Eastern time, 10 o'clock. We'll typically go on for just about 2 hours or so. And let's touch base after that. I've spoken with a number of my colleagues. This does seem the appropriate thing to do. I apologize for the fact that it is not at a convenient time zone for some of you, but really there's no way we can get a convenient time zone for everybody. So, in these kinds of situations, the default option is the default option, and that's what I'm going to stick with. So, but let's continue this conversation. Saying that, first of all, as I mentioned, these Tuesday morning sessions are not mandatory. You're most welcome to participate and attend, but they are not mandatory. You're most welcome to ask questions. I would be very grateful if you would, because they do count in your class participation points. In terms of looking forward, the discussion board questions that I have put in there, you need to do them. I will monitor them on a regular, well, somewhat infrequent basis. I'll not grade each of those assignments, but I will monitor them, and your overall performance on them will count toward your class participation points. So the 10% class participation points, I'll still keep them there. I'm not going to take them away. And believe me, 10% is enough to go take you from a pass to a fail. So so please do the work, the minimal amount of work that you absolutely have to do. I really earnestly request you to do those. So that's I'm going to get back to the materials that we have been discussing. So I'm going to all right. First is let me make sure we're all right. I think the sharing is going all right. So so first thing I'm going to do you is to show you some examples of intraday returns. So this spreadsheet, which is a number 3, NCI trades. Why did I pick NCI? No good reason, because I wanted to share a stock on a particular day with relatively small number of trades. So that's what we're going to do. Okay, yes, there was one last thing which I said in that email to you and also posted on Blackboard, that between now and the end of the semester, I will have at least one conversation with each and every one of you. All right, that we can schedule according to your and my convenience. But we will have one conversation. And so even if you are not able to participate in these Tuesday morning sessions, you will not be disadvantaged, because I will ask probing questions, figure out how you're doing, what kind of questions you have, whether this course is adding value, and all of that good stuff. All right, so what is this database I'm showing you right now? So this is a firm called Navigant. Its ticker symbol is NCI. So as you can see, this is from the dataset TAC, Trades and Quotes, which I showed you the other day, is from that you can get from Words, and you can download all of those. And so for this particular day, 2018, November 6th, I've downloaded all the trades data. One of the assignments that I've told you, the non-graded on the discussion board on Blackboard, is to replicate every single worksheet, work file that I produce to you in class, that I walk you through in class, and is posted on Blackboard. You need to absolutely have all of every single one of them replicated for as part of your assignment. I will go through them, and as I said, not on a regular basis, but not only do you need to replicate, you need to comment on your peers' work files as well in order to do so. Now, one of the things that I've been warned by the director of the program and the counselors of your program, that it is very easy for people to slide into the idea that an online course is not a real course, and therefore assignments or deliverables or emails or these things somehow don't seem very real. It is, please disabuse yourself of any such notion. This is a fully real course with all deliverables. Every single standard will be met. You will not be cheated out of the huge amounts of tuition you pay for this course at this incredible program at a top university. All right, so I'm not taking any shortcuts. I'm doing, in fact, much more work than I would do for an on-site course. This is very difficult. It takes a lot more effort to do it this way, but I'm doing it. So this should not be perceived as in any way less than what you would be doing in an on-site course. All right, so back to Navigant trades on, actually it's 11:06, not 11:07. Let me correct that. All right, so So we start off, let's say, any reason why we're doing from 8 to 4? Well, I mean, typically, so we can just ignore the top two if we don't want to, because they're before 9:30. 9:30 is when the US markets open. So 9:30 onwards, we can look at what's going on. It really doesn't matter that much. This is not a terribly heavily weighted stock. And one of the things that I mentioned to you that even 10 years ago, most of the action in US securities markets did happen during market hours between 9:30 and 4 p.m. That's no longer really the case. A lot of the market action takes place outside of hours as well. Um, so, um, so anyway, so let's say we start off with, as you can see, there at 8:04:29, there's a trade of size 5 at price $21.32. Then there is a trade at 8:15:07 for 14 shares at 21.32, and at 9:30:01, just one 1/100th of a second after the market opens, there is a trade of almost 2,000 shares at a price slightly below the previous price, and so on you go. And you keep going, if you want to look at just the relatively bigger trades, then we can say, let's say greater than 200. So you can see there are how many shares we have? Only 156. So there are, okay, let me take this off first. And so how many trades do we have on that day? So you can see 2,702 trades on that particular day. So, I'm taking a share that is not very heavily traded. So now if you want to see if this is for, my bad, size, number filter, greater than 200. So how many of those do we have? We have 156. I hope you can see it right at the bottom of the left bottom of the screen, 156 of 2,701 records. So there are 156 trades with a size above 200. Okay, similarly, if they're greater than 1,000, how many do we have? So in that case, you only have 11 trades that are greater than 100. Now, you look here, and this, interestingly, you see at 16:02:06, so just after markets have closed, there are two trades with exactly the same size, 36,169. This is something you should look at and say, this does not pass the sniff test. This is just too much of a coincidence. So this is what I've been trying to explain to you. It's really very, very critical that you always understand, you get your hands dirty with the data, go to every single piece and actually talk to the data. By the end of this course, if you are getting into this habit and acquire the ability to speak, have intimate conversations with the data, that's what I'd say would be mission accomplished for me. So as you can see, you can look at these two rows, 2698 and 2699. Most likely it is a duplication. That doesn't seem like it's two separate trades. It's most likely one trade that has been registered, that has been counted twice. Now, this is what we will talk about later, not in a whole lot of detail, is that they're called block trades, and there's an expression in the financial markets of upstairs trades, downstairs trades, upstairs trades, downstairs trades. And so some trades actually occur on the floor, and some trades occur during private transactions. And this is an example, particularly since it's happening after market hours. It's likely one of those upstairs trades, which were done. Done through private negotiations. So this here, now what are we trying to, first thing we want is to get the average price. Now, just you can simply say this here, what I have the average price is, there is absolutely, I mean, you can, for instance, just take the simple average. Now you can see why I picked something with a less number of trades. If we were doing this with Tesla or Walmart or Amazon, this would be a huge number of trades. And by the time we get to getting to the bottom of this row, it would take us an eternity, so to speak. So you can look here, first thing here, let me put this here in yellow highlighting. This here is the unweighted average. You know, is that interesting? Should a trade of size 1 have the same weight as a trade of size 1000? You know, those are pros and cons. They measure somewhat different things. And later on, when we do market returns, we will also see whether there are equally weighted returns as well as volume weighted returns, value weighted returns, my bad. So this here is an example. Now, what we have on the so I'm going to delete, well, let it be. The one that is on row is on F3. This here average price, as you can see, this is the sum product of E3 to E2703. So the price of the product with the weights given by D, the size, divided by the weights. All right. So this here is the volume weighted average price. The VWAP, also said VWAP, for this particular day for this particular security. As you can see, there is not a huge amount of difference, but sometimes you can have a huge amount of difference. They measure different things. So we usually just stick with the value weighted average price. So that's what we are going to do. You know, so far it's quite straightforward. Question becomes about returns. All right. Now, so far, when we have done daily returns, we have gone from the close of one day to the close of the next day. That's how we have counted daily returns. Now, because there is a definite break, mind you, the break is not as important as it used to be 10 years ago, but at the end of the day, there is still a break between the trading day from one to the next. But here, so first thing that we can do is to calculate trade by trade returns. That is to say, for every single trade, we say, so in particular for row number 4, what is the return? We go, that return is E4. That's the price of this trade minus the price of the previous trade divided by the price of the previous trade. That's the return trade by trade calculation. Similarly, for the next one, we say the trade, but the previous trade was $21.32. So, then it went from $21.32, went down to $21.31. So therefore, the return is $21.31 minus $21.32. This whole thing divided by $21.32. So that therefore is the trade by trade return. And so we calculated all the way, like over here is E113 minus E112 divided by E112. So it's all trade by trade. So now we want to say, what is the intraday volatility? What is the standard deviation of returns within the day? Intraday, remember, is within a particular day. Daily returns, so what we have talked about in the past, is from day to day. But in this case, we are doing within a particular day. So the intraday volatility, so in order to do this, we are going to calculate here in K3, in row K3, is the weighted standard deviation. So in order to do that, we are going to first take the squared difference from the mean. All right, so here, H4 minus I3, I3 is the mean, H4 minus I3 squared. This one is H5 minus I3, hence the dollar signs around the I and the 3, because that stays the same throughout this average. So these are the squared differences from the mean. And then when we take the standard deviation, we take the average, the weighted average of these squared differences. And just the way we calculated the weighted the volume weighted average returns, we are going to calculate the volume weighted standard deviation, the intraday volatility of this, by using exactly this expression that we have over there. All right. So, and remember, we have to get the standard deviation, we take the weighted sum of squares, they take the average weighted sum of squares, and then take the square root of that to get to the standard deviation. All right, that's trade by trade calculation. So you're saying from every trade to the next, what is if you bought this trade and the immediately next trade, you bought at this trade, sold at the next trade, bought at the next trade, sold at the next trade. So then what would be your returns throughout the day? That's what this trade by trade calculations do. There is another way of looking at it, which is, of course, calculations from the first trade of the day. Another way of looking at it would be calculations from the last price of the previous day. Or you could have calculations from the volume weighted average price of the previous day. Okay, so the various ways of calculating these returns, and they all have different interpretations. You do what depends on what exactly you're trying to measure. Now here, when we, okay, what did we do here? It is E4 minus E3 divided by E3 when we were doing trade by trade calculations. Here it is E4 minus E with E3 dollar signs around the E3 divided by the dollar signs around the E3. That is to say, on this we have, you're subtracting every single, you're calculating from the first trade. So in this, when you go to row 5, it is E5 minus E3 divided by E3. It is not E4. You're not calculating the return from the previous trade. You're calculating the return from the first trade of the day. And so on. We go down all the way over here, E28 minus E3 divided by E3. All right, so these are this, as you you know, I'm sure you know. If you don't, you should let me know. These dollar signs are a way of keeping them constant. Over here, because we are going to, when we do trade by trade calculations, when we fill the whole thing up, E28 minus E27 divided by E27. Here, on the other hand, it is E28 minus E3 divided by E3. So the weighted average return, calculating using the calculations from first trade, is negative 0.9, which is significantly different from the weighted average return when you do trade by trade calculations. And you should not be surprised. They are different. You know, when you're going from trade to trade to trade to trade, the differences will typically be tiny. So we should not be surprised at all. This is like, you know, when you're doing the way you go from daily return to monthly return to annual return, the return patterns will be different. And later on, particularly when we do options, we will spend a lot of time trying to understand the volatilities and so on and so forth. We will calculate the intraday volatility in exactly the same way as we did here. First, we'll do the square difference from mean. Remember, in every case, we are subtracting, like in this case, M4, which is the return, minus N3, the weighted average return, squared. This gives you all these numbers over here. For instance, M57 minus N3 squared, which gets us to the intraday volatility, which is the weighted, first thing here, it takes the weighted average of the squared differences of mean, and then you take the square root of that. So that gives you the intraday volatility calculated from first trade. All right, now you can see here the intraday volatility is 0.29% when you calculate from first trade. When you calculate a trade by trade, it is 0.047%. So the intraday volatility calculating from first trade is significantly higher than the intraday volatility calculated from using trade by trade calculations. Once again, not surprising at all, because this is what we would expect when you're calculating from first trade. And later on, as we can see, a monthly return will typically have a larger value, larger volatility than a daily return, and so on. That's in a pattern sense. It doesn't mean it holds for every single thing. Now, like we do for every single, so let's do this, plot this for NCI on November 6, 2018. So this is how it starts out at a high price and it goes down, goes back up, goes down, goes up. there is a lot of variation. There are these sudden drops over here, and then there's a pickup and so on. There is a lot more volatility in the first half of the market than in the second half. And that's just the nature of the beast. That's what, the trades happen. So that's what they are. All right. So this is just an example to show you this. So this, this idea of using closing price to closing price of every particular day or month or year to calculate returns is a bit of a legacy approach that is almost unique to US exchanges. Many non-US exchanges, for instance, the Hong Kong exchange, will typically also report the volume weighted average prices, VWAP, that I was telling you earlier. All right, because there is a nuance there, because at the end of the day, if you're if you're only taking the last trade of the trading day's price to calculate returns, what happened in the rest of the day makes no difference. All right. So if you take a purely information economics approach to it and say, well, the average returns don't matter. It's only what matters is when there is the close of trade and information stops accumulating. So there's an argument to be made, but it's these older exchanges for computational reasons that largely we take this approach of using closing price to closing price. Okay. Uncertainty and risk. Uncertainty is unknown unknowns. Risk is known unknowns. What exactly does that mean? Unknown unknowns. So what is the weather going to be like tomorrow? We don't really know. And we don't even know what we don't know. That's an example of uncertainty. Risk is we know what we don't know. We don't know the outcome, but we know what we don't know. So if, for example, objective probability. So if you're tossing a coin, I sent you this article that I wrote recently in response to my daughter's question about what happens when you toss a coin many times. So if you do know that a coin is completely fair, then and if you toss a coin and you say, what is the probability that a particular toss of the coin ends in a head? That probability, if it's half, then that's a purely objective probability. Now, then there is the idea of empirically objective. And that's where a modeling approach comes into place. All right. So when we say that if we want to do a prediction that the market will go up, 0.5% tomorrow. I'm just throwing out a number. It's more than a bit foolhardy to make those predictions because the predictions come with incredible errors. But if you want to do it, that would be based on the models that you have put together as to estimating the probability. So the probabilities then are empirically objective. That is to say, they are based on data that you have accumulated in the past. Similarly, if a weather forecast, when we say you look at your phone and it says there is a 7% chance of rain later today, that means where did that number come from? That is based on a weather model, a mathematical model into which data have been fed from many years, and everything that's going into it, depending on whether there's a pattern coming in from the Gulf of Mexico or the Atlantic Ocean and so on. All of those are fed in order to come up with the probability of rain being 7%. That's an empirically objective. However, having said all this, we don't really make a huge differentiation in finance between uncertainty and risk. And the reason is uncertainty, there is not much we can do about it. So we kind of put everything, we understand that there is a fundamental difference between uncertainty and risk, but at the level at which this course is pitched, I'm actually trying to, I spoke with one of my old colleagues, he's just recently written a paper on the various different financial aspects of uncertainty and risk. I've requested him to come and give a guest presentation to us. We'll see if that might work out. So you can get a kind of a more nuanced view on this. I will leave it with you as the following, that we'll say, well, probabilities are by nature subjective. Because it reflects different information available to different individuals. Okay, so when you have subjective probabilities, then it is essential to do sensitivity analysis. Now, and the reason is simply because it's your probability of a particular outcome. What you think is the probability depends on the information that you have, and your information may not be as accurate. So you need to have your probabilities, your decisions on the basis of the probabilities, be not very sensitive to changes in those probabilities. So that's what we mean by sensitivity analyses. Okay, I'm going to really breeze through the rest of these because this is stuff that you have done in statistics. So measures of dispersion, the variance of returns, if Rx is the return of a security, of a market, of anything. So the measures of dispersion, expectation of Rx minus expectation of Rx squared, that is the variance of the Rx. The volatility of that particular security X is equal to the standard deviation of the returns of that security is equal to the square root of variance of X, variance of Rx. Stuff that you know already. Coefficient of variation is not something that you might have experienced before. It is this is a way of normalizing the units. So it is the standard deviation divided by the mean. And the idea is that if there's a change in units, that should not affect the overall variability. So this coefficient of variation is what measures that. Now, having said that, it's not something we use a lot, but we keep it in mind because we'll see that it comes in different shapes and forms as we go along later on in the course. Measures of co-movement is the covariance between two securities is it's something that you have seen over and over again. Expectation of Rx minus expectation of Rx times Ry minus expectation of Ry. This product tells you if these two returns co-move together or opposite to each other and so on. So this then gives us the variance covariance matrix, where the diagonal elements are the variances and the off diagonal elements are the covariances. Now, as you know by now, covariance is a symmetric, because covariance of Rx and Ry is exactly the same as covariance of Ry and Rx. So, so it's a symmetric matrix. So it's a symmetric function. So the variance covariance matrix, or we just call it the covariance matrix, is a symmetric matrix. And since the variance of Rx is the same thing as the covariance of a variable with itself. So covariance of a variable with itself is its variance. So we can simply rewrite the covariance matrix as a bunch of covariances where the diagonal elements are the covariances with each other within itself, and the off diagonal elements are the covariances between different securities. The correlation coefficient is the covariance divided by the two standard deviations. This one here, this correlation is always lies between -1 and +1. If it is -1, it means they're perfectly negatively related. If it is +1, it means it's perfectly positively related. If it is 0, it means it does not have a linear relationship. Doesn't mean it's independent, it just means it does not have a linear relationship. And finally, if variance of Rx equals variance of Ry is equal to sigma squared, then let's say, then the covariance between these two securities is less than or equal to variance of Rx. I'll go to the summary statistics in just a second, but before I do that, let's ask ourselves some questions. For instance, we often see that should a firm's equity and debt co-move positively? Well, they both have to do with the well-being of the firm. So you can say, well, yeah, they should co-move positively. But on the other hand, they do measure different aspects of the firm, and they are substitutes as far as the investor is concerned. So they should, there's an argument to be made why they should move negatively. It's not clear-cut, and it's really, those are the kinds of things. There is no good theoretical reason for them to move, either co-move positively or negatively. It's fundamentally an empirical question, and that's what we will, it's only data that will answer that for you. We will do, when we do asset pricing models later, this will turn out to be quite important. So now, because you are important, we understand that these expectations, variances, standard deviations, covariances, correlations are all relative to investor I. Okay, you and I can have very different summary statistics, and so we will we should subscript I to denote the fact. For instance, expectation I is the expectation of EI is of RX, is the expectation of return of security X with respect to investor I's information. And similarly, SDI is the volatility of security X with respect to investor I's information. There is no reason to believe one set of summary statistics is superior to other, except in the sense that Warren Buffett's information might reflect more better quality information than mine. But the point is, subjective information, these all reflect, and we have to take each investor's investors' information into account. All right, now let's go look at some data. All right, please follow along with me. Go to Words. Remember, it's H640SU20. That's your username. The password is F1NANCE2020. Submit. Please review. Get data. Crisp. Stock security files. Let's get monthly stock files. And I want to say we go 1925-12 to 2019-12. And let's look at the ticker for Google. G-O-O-G. What are the things we want? Company name, ticker, price, holding period return, volume, number of shares outstanding. And this is what I was telling you earlier. Value weighted return for the market, equal weighted return for the market, and return on the S&P Composite Index. All right, let's download it as an Excel spreadsheet and use the US date convention, which is month, date, year. Okay. Now, please download this data as we speak, because there is really no point in your looking at the screen and without doing it yourself. You really need to do it yourself, because you will be asked to do this on your exam and on the assignments that I have posted. And unless you're able to do all of this stuff on the exams, you will not pass this course. And much more importantly, unless you get your hands dirty, unless you really understand financial data, there is really no point in taking this course. Okay, submit query. All right, so this is what we have. Go to download, Finance Summer 2020, Google monthly returns. All right, so let's enable editing. I'm going to, because I like things to, I'm going to put them all in column width 15. Change all of these to no fill, put them all in black. This top row, I'm going to change the row height to something I can handle, otherwise I can't see, so 75. All right, now, first thing to know, one of the things that I do want you to understand is this will give you all kinds of interesting issues here. So we need to be extremely careful, get our, think through everything and then work. First of all, if there is a day for which price is missing, first of all, let's price or bid ask average, if indeed, if it is price, then it will actually show up as a positive number. So in which case, Google, as we know, for all this time, it's traded. If there is a trade, at least one trade on each day, then it will show up as a price because there is a trade. The point is, if the bid ask average is reported, if there is no trade for a particular security for a particular day. Of course, for a very heavily traded security like Google, that's so we can just say price. Okay, it's not names date, it's date. All right, now this is, as I said, if price is missing, then it's not a legitimate row. So we are going to do our due diligence and delete all those rows for which price data are missing. All right, now we will now, as I said, get our hands really dirty with the data. So price, these are in dollars. So we are going to put them in currency, decimal places 2. Volume is in numbers. No reason to have decimal places. Okay. Returns are, we are going to put them in percentages. Okay. As you can see, the first here is a C because 4/3/2014 on that particular day, there is no return because that's the first day of trading of this particular security, which I will get to in just a second. Now, this thing here, which is says shares outstanding, is actually not shares outstanding. It's actually shares outstanding divided by 1,000. Why do they do it? It's historical reasons. No good reason, really. So then I'm going to insert, so shares outstanding, which is equal to shares outstanding times 1,000. And, I populate the rest. Anytime you do a population, you should check to make sure you're doing it right. Now, this here is exactly the same format. So I'm going to go here, Format Painter, click on shares outstanding, which then gives you the number of shares outstanding, time with commas and so on. So in particular over here on 04/30/2014, the number of shares outstanding of this particular security is 337,247,000. Finally, I'm going to introduce yet another is market cap. That is equal to price times shares outstanding. Okay, this here is in dollars. So we are going to currency, No need to have decimal places, and so on. All right, so we have market cap. Now these value-weighted returns, so these returns are also in percentages. So I'm going to just go to home, format painter, format these three to give us the returns, the value-weighted returns. I'm going to move this out a little bit, and so that you can see the market cap and so on. All right, so we now have a bunch of data points to look at. First thing to note is one of the greatest things about CRISP is this perm-no. It's the permanent number. It's a permanent identification for any firm. So if a firm, for instance, changes names, its ticker can change and so on. If it has a new class of securities, its name can change and so on, but its perm-no stays the same. So the best way of keeping track of a security across an acquisition, merger, everything is this permanent number. So we're looking at, we have downloaded all the data for Google, right? You know, since the beginning of time, hang on, but we see two different securities here. Why is that? Let's go to the lower one, 90319. Aha, now this is where the first day on which Google actually went public. 90319 security is this ticker symbol, Google. It IPO'd on August 31st, 2004. That was the original Google. Okay, so it closed on the day of the IPO of $102. There is no return because there is no previous closing price. The next day it closed at $129.60. The return therefore was 26.6%. Okay, this shares outstanding, because it's kind of distracting, I'm going to, I'll let it be here. Okay, returns. So shares outstanding of this and so on. And this particular security, we have data from 8/31/2004 all the way until the end of 2019, which is the entire data for Google. Okay, now let's go and look at the names. There's Alphabet Inc. and Google Inc. Interesting. So what happens here? On 10/30/2015, Google, well, actually, let's go back to, let me identify this with a yellow, and row 205 with a green. Too green, we can't see well. All right, so what happens on April 30th, 2014? There is well, these are monthly data. These are not April 30th, 2014. This is in May 2014. There is a change. Okay, let me make sure you're all on board. These are monthly data. These are not daily data. Okay, so monthly data in April. So and we'll see in a second that different data sets often calculate the monthly data in a different way. So this, one of the great things about Words in CRISP, it reports the monthly return as the last day of that particular month. So in April 2014, and look at the March 2014, the data actually, the ticker symbols changes from GOOG to GOOGL. Keep this date in mind. April 2014. Keep this month in mind, April 2014. And we'll see a little bit later why this is important. Now let's look at 10/30/2015. What happens in October 2015? Google changes it kind of restructures itself. Google becomes a fully owned subsidiary of this Alphabet Inc. And Sundar Pichai becomes the CEO of Google, and I think Sergey Brin becomes the head of Alphabet Inc. So there is this restructuring. Whether it was a good one or a bad one, that's really not part of this particular module. We will discuss those kinds of things later on, but that's what they did. Okay, these are all in the, but you see the ticker symbol has changed between here and here. But because it is the same security, the perm node doesn't change. So it's always important to keep in mind that it's the perm node that really keeps track of a security across various transitions that might occur. Now, let's go look at the other security. When does it start? May 2014. So May 2014, remember that was the time I was telling you earlier, the other yellow security that we had. It's on that day that Google introduces not day, my bad. On that month, Google, as a part of, it changes its ticker symbol, the new sub-security that it issues, subclass of equity. In this month of 2014, it transfers its old ticker symbol GOOG to this new sub-security. Okay, and as we saw earlier, in October 2015, you still have what we did earlier with the old security. It changes its name. So the names, it's the same, the two sub-equities of the same firm, okay? One with the ticker symbol GOOG, one with the ticker symbol GOOGL. Now, it's interestingly, of course, that one that used to be GOOG is now GOOGL. So the only way to clearly keep track of that is through the perm now, all right? All right, so now this, in order to, there are many ways of looking at it, because there's no good reason to think that the two securities should have exactly the same returns. I mean, because they have different voting rights and different classification. They're not perfect substitutes, although they're very closely related. So what I'm going to do is to actually just look at the older security. So I'm going to delete these. So now I only have the 90319 security, starting from its IPO till the end of 2019. Let's look at the market cap. It's on this day, it's on the first day of IPO. It closes at $102.37. There are 33 million shares outstanding. So the market cap at the end of the first day is $3.4 billion. It jumps to $7.5 billion the next day. So it's a huge jump. And over here, on the 12/31/2019, the market cap is $401 billion. Now, that's not the market cap of Google as a whole, because as we have discussed before, Google has two different equities that it has issued. So in order to get the market cap of Google as a whole, you would have to add the two up to get the Google. But I mean, because I'm trying to understand these in a particular way, so I'm going to just keep these as the way they are. All right. Now, this is the value weighted return, including dividends. Now, if you go to, we will later, actually, this is actually a good time for me to show you. So if we go to Yahoo Finance, and let's say we go for the DJIA, which is the Dow Jones Industrial Average. This here is the most well-known in market index in the US, which is, as you can see, the Dow Jones today started off and then went down and then has gone up quite a lot. How has it done year to date? Started out pretty well, and then we had the huge coronavirus impact, and it's come up pretty close to where it was. It's now today, yesterday it ended at 27,402 and started the year at 28,868. So there has been a substantial climb back. Okay, so this is the Dow Jones Industrial Average, and this is how the Dow Jones has changed over, over the last 35 odd years. Now, this is not the max, but that's how we report it. This is the Dow Jones Industrial Average. Now, the Dow Jones Industrial Average is an average of, well, not exactly right, but let's say the top 30 US publicly traded firms, the top 30. Right now, that's something to keep in mind. It's only the top 30. Now, why did we take the top 30? Because in 1926, when the Dow Jones first started being calculated, remember, we really didn't even have, these calculators anymore then. So what we had was pencil and paper, and so that's all they do. So calculating a return for the average return for 30 stocks, was difficult enough. By the time the 1950s came along, you had the Manhattan Project, which was the huge development of the nuclear bomb. That created demands for a lot of computing power, and that really made computing take off in the US and the world. And so that's when we found that we had the, in 1950s, they went from 30 firms to 500 firms. So this is the Standard & Poor's 500, which is, loosely speaking, the top 500 US traded firms. So these are, in today's world, the two major indices. In academic research or in, most research, Dow Jones is not particularly useful except for comparability to historical results. When we talk about the market, the S&P 500, because it has a much larger base, that's what we go with. So here is, if you want to look at historical data for the S&P 500, let's just look at year to date of the S&P 500. So you can see started at 3,213. Today it is 3,232. So last night, the S&P 500 actually recovered and went back to what it was at the beginning of the year. So the losses that it suffered because of the Great Recession, it has recovered from all of that. So this is interesting. Even though the economy seems to be going south, the overall market seems to be doing well. So these are the two major indices that we often will talk about. However, let's go back to our data that we were looking at, the Google data that we downloaded. We also have this value-weighted return. And this is to say, why restrict, now that we have so much computing power, why restrict ourselves to only the top 500 firms? Let's take every single publicly traded equity in the firm and then weight it by its market cap and take the value-weighted return. Well, including dividends, because these holding period returns include dividends. They're split adjusted and dividend adjusted. So that's clearly to be done. You can have the excluding dividends. That, of course, measures something quite different, which is not that interesting for us. Earlier, I was discussing with you when should you have equally weighted versus value weighted. So, for instance, NCI, which we talked about a little bit earlier, Navigant's market cap is about $1 billion. On the whole, Apple's market cap is $1 trillion, 1,000 times more. When you're calculating the average for the market, should Apple's return and Navigant's returns be given the same weightage? If yes, then you use equally weighted, depending on what you're trying to measure. On the other hand, if you say that the top, Apple's return should be given, because it has a 1,000 times more valuable, it should be given 1,000 times the weight of the return on Navigant, then you take the value weighted. The problem with using value weighted, it then completely, it's really dominated by the top firms. So in that case, you'll see that the value weighted return and the S&P 500 returns tend to move much more closely than the equally weighted, because the equally weighted returns give equal weights to Navigant and Apple, even though Apple's market cap is 1,000 times that of Navigant. And the return on the S&P 500, the NCI, Navigant doesn't even show up there, so it gets zero weight. So return on the S&P 500 index is as follows. All right, so this is what, it's a kind of a walk through some data on Google. Now we are going to actually go through and calculate some summary statistics, show how all of this is done, and let's take a short break. And so it's 3 minutes past 11. All right, so welcome back. Just as I mentioned in a previous email, I will post this video back on the cloud on the same link that I have sent you before. So it will be available to you by the end of the day. All right, now I'm going to go to another data set that I have talked to you about before, is the FRED, which is a St. Louis Fed. So if you can see on my screen, just let me make sure that you are indeed seeing my screen. Yes, you are. So it's FRED, St. Louis Fed.org, and it has all kinds of data here. What we are looking for is the 1 month treasury rate. So as you can, the treasury constant maturity 1 month. That's what we want to look at, and we want to get daily data for this. Okay, so 1 month treasury constant rate, but this is in daily format. Let's get them in monthly format because that's what is relevant for us. So let's get the max for this. The 1 month treasury maturity rate, it starts really in July 2001. At that point, it is 3.67. Then it falls a lot. This is during the easy money of the. All right, so we will actually do this treasury rates when we do fixed income securities. This is the rate that the US government has to pay in order to, the interest that the US government has to pay to somebody who is willing to lend money to the US for 1 month. So this is for a debt security that matures in 1 month. That is the rate. So it goes up to 4.90 over there, and then there is this huge dramatic fall, and this is where the Great Recession at 0.03 and stays at pretty much zero throughout President Barack Obama's tenure. And then it goes up quite drastically, and then in February 2028 it goes down, and in May 2020 you can see it's 0.10. It's practically zero again because of the Great Recession that the Great Cessation that we find ourselves in. Okay, later on we'll see that this here is the treasury rate is a market determined rate. This is not something that the US government can control. Now, within the US government, the Federal Reserve is an autonomous entity. It's separate. Its monetary policy is different than the fiscal policy of the US government. So they are independent entities, and that's something for many of us who grew up in different systems find it a bit difficult to understand. But in the US, this autonomy, this independence is very zealously guarded. So we will, when we do fixed income securities later on, we'll see that the US Federal Reserve can set only what's called the discount rate. And that is of course, one of the inputs into the market determination of this, the treasury rates, which are the risk-free rates that we will look at. Why are they risk-free? Because the US in its entire history has never defaulted on its sovereign debt. Argentina just defaulted a week or two ago. Argentina has already defaulted something like 5 times in the last few years. Russia has defaulted. Thailand has defaulted, but the US has not defaulted, which is why we always refer to US federal government debt as risk-free rates, but they vary depending on what they are used for and how much the maturity is. And when we do fixed income securities, we'll go into much more detail on this. So you can download this as an Excel data set, and we go to downloads, finance, summer 20, let's call it, okay, GS1M, save, and so on. Okay, this will, I didn't like it. Let's download it as a CSV data. Okay, which is CSV just simply means it's comma separated. You can open it through Excel. And so this is what it looks like. Okay, so and I'll show you in just a second. So this is how the data here is for the entire history of this 1 month maturity treasury. It's starts in July 2001, and 3.67 is the annual interest, annualized interest rate that a lender to the U.S. federal government for 1 month maturity gets paid for this particular month. These are monthly rates. One problem that we will see, and I'm going to just close out of this and show you in the data that we have. Now, if you go to the data set work file 4, and you can see here, there are the raw data. This is the T-bill monthly returns that I have downloaded for previously. So one of the things that we saw earlier, the observation date for T-bill monthly returns is in the form of it's reported. So for the beginning of the month, but we saw in the data that we downloaded from CRISP, the monthly data are reported for the last day of the month. So this is a problem when you're merging data sets from various different sources. You have to make them consistent. You have to put a lot of effort into getting them right. And so please spend a lot of effort following through with me. One thing you cannot do, and I cannot repeat it enough, you cannot merge 2 data sets next to each other, because that is wrong, absolutely wrong. You will get 0 points if you just stack data sets against each other. And let me show you in a second. First of all, the observation date is 2017, but it is actually being reported as 701, but it is actually for the previous, for the last monthly return for the previous month, for July. For June of 2001. So from this, we extract the month. So this is the date, 2001-06-30. You take month of B2, that extracts the month of this. This extracts year, paren B2, extracts the year corresponding to this. And year month is, I'm just concatenating. Now this data work file, as I said, is on on Blackboard. And it is part of your assignment to replicate all of these data sets for this particular. So you need to download to make sure you're getting it right and make, okay. So this GS1M is the data that, this is for, not as recent, but this is what we have here. Now, this here is monthly, this here is annualized. But go back to our comparable returns. It was monthly return from the close of the previous month to the close of this month. That is the monthly return that we are looking at for all the other securities. So therefore, we need to first, this F2 divided by 100 to get it to, because this one is 3.67%. It is not 3.67. It is this thing divided by 100, which is, and then divided by 12. All right, that gets you the monthly rate for this particular security. If you want to look at this, you can put this in percent, but because this is a very low return, you'll see that the risk-free rates are significantly lower. So this here, once again, is 0.306% is the monthly return on this particular risk-free security. The risk-free geometric, because it is really compounded, it really should be done in this format. It's something you can figure out. You can see, but these kinds of things, they make absolutely the next column I is the absolute difference between the geometric calculation and arithmetic calculation. There is practically no difference because the numbers are so tiny. So we'll just, for our purposes, we'll use the arithmetic risk-free return. And later on, we'll see when we do fixed income securities, you know, the reason the risk-free was, the arithmetic calculations were used was simply because historically, they were just much easier to calculate, much easier to compute. You know, now for us, it doesn't make a difference, but for historical purposes, we'll just, for historical comparability, we will kind of use the arithmetic, but as I said, it makes no real difference. So these are the T-bill monthly returns. And because these are month, we need to have this common element for each. These here are the returns for Apple. But these are the monthly returns for Apple that we have downloaded. Once again, these are monthly returns, but as I was mentioning to you in the CRISP data, the monthly returns are reported at the end of the relevant month. So while in the T-bill returns, we had to subtract it to get it to the previous month, we don't need to do that. We can directly extract the month and the year, concatenate them, and take this returns are the Apple returns. These are the value weighted returns. These are the returns on the S&P index. Similarly, for Google, we only have the 90319 returns. We do exactly the same thing, extract the year, month, and show the returns for Google. These are the returns for NCI. We do exactly the same thing. These are the returns for Amazon. We do exactly the same thing. These are the returns for Walmart. We do exactly the same thing. Okay, now please pay attention here. Now we have this. You cannot simply copy and paste the monthly returns for these. You just cannot do it. Okay, for monthly returns, it doesn't make usually that much of a difference because there will typically be data for each month. But later on, when we do daily data, and we, let's say, are comparing US data and Brazilian data. Thanksgiving is a holiday, is a trading holiday, and the markets are closed in the US on Thanksgiving. Whereas on that same day, Brazilian markets are still operating. So if you just tag them for each other, the dates will not align and you will get wrong results. If you're using a more advanced software package like Stata or SAS, which is really what I do for all my research and consulting, merging is much more straightforward. In Excel, you still have to do it. You just have to be a bit more careful. All right. So first thing to do is we create exactly, because we're going to use, we have to create, that was the whole idea of creating this year-month field, because this is the common field with respect to which we are going to merge all these various different raw data sets. So this gives you so in order to calculate the monthly returns for Apple, what are we going to do? We're going to do this VLOOKUP. Follow along with me. Equals VLOOKUP, which, what are you looking up for? This first. Where are you going to look up for 2010-1? Where are you going to look it up from? From AAPL monthly returns, starting at year month, starting at E, select G to H, E, F, G, H, 4 columns, monthly returns E to H, comma, 1, where is the Apple return? First column is year month, second column is Apple return, comma 2, and then comma, false. Now, don't ask me why it's false, because it's Excel's unique eccentricity, where it says false for exact match and true for approximate match. That's what it is. So this gives you the VLOOKUP for 2010-01 for Apple monthly returns for Apple, and then you populate the entire field. Similarly, in order to get the monthly returns for Google, VLOOKUP, what are you looking up? This, comma, where are you looking up from? From Google monthly return. This is the field that you're looking at. That's the array you're looking at. What is the column? 1, 2. First column being year, month. Second column is the Google return. False. This gives you the monthly return in October, and then you populate the entire field. Similarly, you do it for all of these. Now, how do you get the monthly returns for S&P 500? Okay, you go VLOOKUP, year, month. Now, we saw earlier that when we downloaded Apple returns, we actually had downloaded the S&P returns as well. So we are going to take the common field, year, month, these 4 columns. S&P returns is 4, comma, false. That gives you the monthly return for S&P 500. Similarly, the monthly return for the value weighted equity index, VLOOKUP, we had downloaded it for Google, for Apple, VLOOKUP, go to Apple, year, month, 1, 2, 3, 4, the 1, 2, 3, E being 1, column F being 2, column G being 3. So this is 3, comma, false. So this is the monthly return. And finally, we need to get the monthly return for 1 month US maturity, US debt. So we will do VLOOKUP, which day, we're doing it for this particular month, comma, where are we getting this data from? From this data set, starting with E, we selected this, which number? 1, 2, 3. So 3, false. We have populated this entire field. So now, having done that, then we look at this. We just look at the average. So the monthly return average for Apple is 2.15 over this 9.5 years. Monthly return for Google is 1.5. Monthly return for NCI is 0.8. Monthly return for Amazon is 2.82. Monthly return for Walmart is 0.9. The monthly return for the S&P 500 is 0.93. The monthly return for the value weighted equity index is 1.02. And the monthly return average for the 1 month maturity US debt is 0.02. The standard deviation, which is the volatility of monthly returns for Apple, is 7%. For Google is close to 7%. For monthly return for Navigant is 9%. Monthly return for Amazon is 8%. Monthly return for Walmart is quite a bit lower. For the overall market, for S&P 500 is 3.41. For the value weighted equity index is 3.48%. And the volatility for the monthly returns for US maturity debt, 1 month maturity debt, is 0.03%. So let's look at this one again. The volatility for Apple and Google are quite similar. The volatility for Navigant is quite a bit higher. The volatility for Amazon is lower than Navigant, but still higher than Apple and Google. Walmart's volatility is much lower. The market volatilities are for the S&P 500 and the value weighted equity index. The volatilities are quite similar. The volatility for the monthly return US debt, 1 month debt, is 0.03%. In principle, should be 0, which is what we'll talk about later. But data are always much more complicated than they are. So now we show the variance covariance matrix. These are orange diagonal elements, as we have said before. These are the variances, which the covariance of each with itself is the covariance. So naturally, these gives you the covariance of Apple's return with Apple's return is the variance of Apple's return. So that's why those are the diagonal matrices. So so let's look at this. Apple's covariance with Google is 0.17%. With Navigant is 0.11%. Well, because Navigant is quite a different market. With Amazon, it's 0.18%. But look at this very interestingly. Apple's covariance with Walmart is practically zero. And later on, we'll see that when we do Walmart for much later in our time period, it actually starts behaving more like a tech firm. During this period, Walmart it's a brick and mortars retail outfit. So, just a different market altogether. Apple and monthly return for S&P 500 is well correlated, not by much, and monthly return for Apple with the value weighted equity index 0.11. The value covariance of Apple with a monthly return on US debt is pretty low. And that's to be expected because monthly returns of US equity debt in principle should not be varying at all. So the covariance should also be zero. Okay, let's look at this particular. The S&P 500's covariance with the monthly returns for value weighted equity index. Look at this. The variance, the S&P 500's volatility, the variance is 0.11%. Its covariance with the monthly returns for the value equity index is pretty close to its own variance. And that's what I was telling you earlier, that it's not surprising at all, because when you have the S&P 500, it's the top 500 firms. But when you take the value weighted equity index, you're putting so much more weight on the firms with higher volatility. Sorry, my bad. When you're putting so much more weight on the firms with higher market cap, so you are effectively making the value weighted equity index very similar to the S&P 500. So this is all posted on Blackboard. So please look at that and replicate these as you go along. Okay, diversification with two securities. I'll let you go through these slides, and at your convenience, I want to now walk you through some actual calculations for what diversification means. All right, so let's say we have Apple and Google. All right, and let's say we take just Apple and Google, and we create this portfolio with 50% share of Apple, 50% share of Google. Then the monthly return for this constructed portfolio is this D3 times F2 plus E3 times G2. Okay, so that's the monthly return for this constructed portfolio, where 50% of your money is in Apple and 50% of your money is in Google. So if you take this equally weighted portfolio, then the average return for Apple is 2.15%. The average monthly return for Google is 1.5%. And the monthly return for the constructed portfolio is, well, in the middle of those. That's how we expect. The volatility, however, is quite a different beast. And this is the idea of diversification. That, look at this. The volatility of Apple is 7%. The volatility of Google is well, close to 7%, whereas the monthly return for the constructed portfolio is a good over a percentage point lower than the volatility of each of its components. And that's the idea of diversification. Okay, so please keep that in mind. We will always talk about this. Now, let's do a couple more examples. Let's take, just as we had with Apple, now if we do Apple, Google, and Navigant, we equal split of this equally weighted portfolio. The averages of Apple, Google, and Navigant are as follows: 2.15, 1.5, 0.8. These are the averages. The average of the monthly return is somewhere in between, as is expected. Average is a linear relationship. Volatility, look at that, 7%, 7%, 9%. The volatility is about 5.5%. So by diversification, you have reduced the volatility. All right, and you can go and let's say we take the other extreme. We have, let's say, a portfolio of 5 securities: Apple, Google, NCI, Amazon, Walmart. We have equally weighted, and then the averages are 2.15, 1.5, 0.8, 2.8, 0.79, and the monthly return is in between, to be expected. Look at the volatility: 7%, 7%, 9%, 8%. 4.8%. The volatility of the constructed portfolio is smaller than even the lowest volatility. Now, that does not always hold. That does not always hold. But this is a general pattern we'll see. And in the slides, I walk you through the calculations about under what situations we will get these kinds of diversification results. So, so reduction of volatility through diversification increases through this parameter sigma squared, which is the variance, and lambda, which is the covariance, the difference between the two. Okay, so and then I walk you through the diversification with the general number of securities. So variance of R is a function of this 1 over n times sigma squared plus n minus 1 over n times lambda, which is less than lambda squared if lambda is less than sigma squared. So therefore, if the securities are negatively correlated, uncorrelated, or just not perfectly correlated, combining them strictly reduces volatility. Not the same thing as being good investments, which we will do very, very shortly. So for instance, you put together a bunch of mortgage-backed securities with low expected return, you will still get a pretty bad security if you combine a bunch of a portfolio of pretty bad returns. Your volatility will go down potentially, but that's diversification by itself. It reduces volatility, but that's not the only criterion for an investor, which we will get to in just a second. All right, let's, so this is what happens when you have diversification of equal shares. Let's see if we can figure out what if you had, so let's say you started off with equal percentage. All right, so let's, as we had Apple, Google, Navigant, Amazon, Walmart. This is the monthly returns of the constructed portfolio. This gives you the averages, and this here is the volatility of the constructed portfolio. Okay, so now we said earlier, we just said, okay, this is the equally weighted portfolio. But now let's try to construct a portfolio when the components are just these 5, but we change the weights so that this volatility is minimized. So in order to do that, we go to data, solver, we say set objective N112, which is the volatility, minimize it by changing variable cells I2, K2, this is what we're doing here, I2 through M2. Okay, this is what we're changing variable cells. What are our properties? All these weights have to be less than or equal to 1. Later on, we'll talk about what if, can these weights be greater than 1? Can you have a negative weight? In principle, this is the idea of going short. That is how possible. But also, they have to add up to 1, which we're just rewriting as M2 equals 1 minus I2 minus 1 J2 minus K2 minus L2. We're making the unconstrained variables on negative. Solve. Okay, set objective is N112, sorry for that. So set objective N112 by changing variables I through to M2, subject to all these constraints. Click on solve. So, okay. Look at that. So in terms of the diversification, the lowest volatility portfolio would say 16% of your money on Apple, 11% on Google, 12% on Navigant, 5% on Amazon, 55% on Walmart. That's not surprising. Look at Walmart's volatility. It is the lowest of these all. And so if your only objective is to minimize your volatility, that's not necessarily a good objective, then this gives you the minimum variance portfolio for this particular when you have these 5 components of your security. All right, so this one is posted on Blackboard, so please look at that. Okay, this normal and log normal, I will actually get to it later on when we do options. So it's there, but I'm not going to walk you through it today because it's really becomes much more important when we go do options and so on. So I'm going to log out of this. Finally, there are one of the things that I mentioned to you over and over again in this course, that my slides, my lecture notes are meant to be they're very comprehensive. They're meant to be as reference material. So I will often not cover all of these things, but those are things for you to look at, be aware of, be very careful as to be able to do it. But for your exam purposes, I will not ask you to do things that I have not covered in class, but you should absolutely look at. Okay, let me quickly. Okay, so we talked about risk preferences. So one of the things that we are going to ask about is this investor heterogeneity. So utility function has to be increasing. Then given utility individual's eyes subjective utility function, we'd say you're an expected utility maximizer if you maximize expected utility of your outcome. So now there are 2 sources of heterogeneity in investor evaluation. One is the common value but asymmetric information, which we have talked about earlier. And now it's this new approach to risk, the UI, which is private value. And I cannot emphasize this enough, is this idea of investor heterogeneity. A lot of old style finance courses, they really don't go beyond investor homogeneity, and which is absolutely tragic, because if you only understand homogeneous investors, then you'll never understand why investors trade, why there is any trading volume at all. So it is something that we will be very careful to try to understand. So as I mentioned, there are these 2. So question now is, what are some interesting utility functions? So I've talked about a number of those. In finance, what we use most usually is the idea of quadratic utility. So quadratic utility simply says your utility is increasing in the expectation of the portfolio and decreasing in the variance of the portfolio. Okay, so more the it's very straightforward. More return, happier. more volatility, less happy. So, you know, more return, good, less volatility, good. That's the trade-off. Question is, how do you trade these two? And this AI is the investor's degree of risk aversion. So higher the AI, more the negative influence of volatility. That is to say, more the aversion for risk. Limiting case, if AI is equal to 0, then you don't care about the volatility at all. All you care about is the expected return. So that is the case of risk neutrality. That's the situation where you only care about your expected return. All right. So this quadratic utility, so we can think about it as, let's say where A equals 1. The indifference curves are y minus x squared equals 1. This is y minus x squared equals 3. So this is the indifference curve here for when the utility level is equal to 1. This is y minus x squared equals 3. This is the indifference curve for when the utility level is equal to 3. And so the direction of preferences is northwest. So that's the idea of indifference curves for quadratic utility. There are various other views. In particular, I have this paper that is under review on implicit uncertainty, which you know, it's a bit too advanced for you, but I will post it on a Blackboard in the near future. Okay, now this is something that I cannot emphasize enough. Anytime you're doing any analysis, especially when there are subjective probabilities involved, when there are subjective utility parameters involved, to look at this sensitivity analyses. Okay, so you have to do your work with different values of the parameters to look at different in particular probabilities and so on. And this really, you need to really have a very good understanding of this course. Let me quickly go to the file that I sent you yesterday about this foreign FCOJ, frozen concentrate orange juice futures. So your initial asset is $2 million. You can choose to buy or not to buy FCOJ futures by spending $1 million at 9:30. That is before the Department of Commerce announcement. After the announcement, you can choose to sell or not sell FCOJ futures. But this is the part where we are actually abstracting away from any kind of short sales, but you can sell FCOJ futures only if you actually hold inventory. If you hold 0 holdings, then you cannot do it. Okay, so if the price of frozen concentrate orange juice will go up if the new information suggests that there is going to be excess demand, and similarly it will go down if the new information suggests there is going to be excess demand. So if you hold futures, then you can sell after the announcement as follows. The crop predicts excess demand, you can sell your futures at a profit of $1 million, or you can take no action with no profit or loss. If the crop report predicts no excess demand, you can sell your futures at a loss of $50,000 or take no action with a loss of $75,000. Empirical evidence suggests that there is 20% chance of the orange crop being negatively affected by the weather. So I emailed this to you yesterday and requested you to read it. I hope you have. So we are going to model the above problem and solve for optimal decision. Sorry. Sorry, excuse me. All right. So A and B are covered in also in the, and it is very straightforward. I'm going to now, the quadratic utility is what we focus on mostly in finance. So that's what I'm going to, and I'll just kind of touch on the other things in a bit. So let's look at the quadratic utility. Remember, the quadratic utility, only things that matter are returns and expected return and volatility. Mean return, volatility return. That's it. And how you trade off the two, that depends on the parameter of the quadratic utility function. Okay, let's make sure we understand that. Starting asset is $2,000. You put in an investment of $1 million. The risk-free outcome is you get an increment of 0, which means your return is 0. Expected return is 0. Variance of return is 0. Volatility of return is 0. Expected return is just D3 because there is no risk. Variance of return also equal to 0. And this variance of returns time is also 0. The quadratic utility of so we said the parameter, let's say, is 1. So then it is equal to 0, expected return 0 minus half times 0, also 0. So this is equal to 0. This by itself doesn't prove anything. This is you remember, in utility space, it's purely an ordinal measure. It's a comparison that matters. There is no specific interpretation to this 0. Now, going back to those things, if you make that investment of $1 million, there is a possibility that you might have an increment of $1 million, in which case it is increment of C4 divided by B3, return of 100% with probability 0.2. That, remember, is 0.2 is the probability that the orange crop is negatively affected by the weather. So there can be 100% return with probability 0.2, or you could lose 50%, $50,000 with a probability of 0.8. If you lose $50,000, that's a return of negative $50,000 over an investment of $1 million. So this is a return of C5 over B3, negative 5%, probability of 0.8. Okay. The expected return is simply this here is F3 is D4 return times probability is this one, D4 times E4. This return times probability is D5 times E5. Sum of the two is, you remember, the probability is simply, if you have two values, x1 times p1 plus x2 times p2 is your expected return, which is 16%. The variance here is where we did earlier, D4 minus F6. The D4 is return minus F6, which is the average return, squared times the probability. So this here is the difference from the mean squared times the probability. Difference from the mean squared times the probability. Sum of the two gives you the variance of the risky option. What is the volatility? The square root of 2, which is 42%. So now then, what is the utility of this? F6, which is the expected return, minus expected return F6 minus half times I2, which is the parameter of the quadratic utility function times G6 or H6 squared. Doesn't matter because it's that's what it is, 0.07. This here gives you the nested. What's the solution? If J3 minus J6, so 0.07 is greater than 0.0. So the expected utility of the risky outcome is greater than the expected utility of the risk-free outcome. So in this case, you will decide to buy. Let's say your parameter is 10. The parameter of the quadratic utility function is 10. Now remember, what is the parameter of the quadratic utility function? The higher the A, the more your aversion for risk. So if in particular the parameter of your quadratic utility function is 10, for instance, for me, it's my individual investor. I have, for instance, I'm in my 50s. I have a daughter to put through college. I have to worry about my wife and my retirement. So I might be extremely risk averse. So my parameter for quadratic utility function might be 10, whereas yours could be 1. So if it is 10, then in this case, you can see the expected utility of the risk-free outcome is 0, whereas the expected utility of the risky outcome is negative 0.72, in which case 0 is higher than negative 7.02, and therefore you will buy. You will stick with the risk-free outcome. You will decide not to put in, not to buy any of these investments, because you are better off. You have a higher expected utility in the risk-free outcome than in the risky outcome. So you can play around, change these parameters, and work with these. I'm just quickly going to go to the, you know what, look at the log utility, the log preferences, also these things. But you know, don't worry about it for this particular course, but you do need to understand that there are various other utility functions that often serve very interesting purposes. But for finance, we tend to stick with quadratic utility functions. And next week, we will do, not next week, the week after that, we will do a bunch of optimal portfolio calculations using quadratic utility function. Okay. Okay, so what is the long-term utility maximization, therefore? So a security's present valuation for investor I equals the certainty equivalent, okay, of the net present value of future income streams. This is what we call the discounted cash flow for that firm or for that security, whatever the relevant objective is. For example, you have a security that makes payments X1, X2, X2, XT in periods 1 to T. Think of this as a dividend, an equity that makes regular dividend payments. They could be 0. You know, a lot of these, like Tesla has never paid a dividend. So these X1, X2s could be simply be 0. Then for a risk neutral investor, valuation at time 0, P0 equals summation T equals 1 to cap T, delta I to the T. I remember this I is because of the investor I raised to the power T, expectation of I, because this is a risk neutral investor, times the expectation of the dividend payments in all these periods, plus delta I to the power T plus 1, cap T plus 1, the expectation given this particular investor's information set, PT plus 1. Now, delta, what is delta? Is investor I's discount factor, which we will talk about in just very simply in the next slide. And later on, when we do CAPMs and so on, we will actually put a way of trying to estimate an investor's discount factor. We'll talk about that later. Now, but this is the point to remember here. Cap T is also a decision variable. And this is the part that we have talked about before. That to understand holding period return, P naught to PT plus 1 is the capital gains, and the XTs are the dividend yields, the dividend payments for, so all of those come into place. But when do you exit this security? When do you sell out of the security? So cap T is also a decision variable. So for instance, if you own a home, and you get the rental, monthly rental, and you're renting it out. So the rental payments that you get every month are these X1s. And when you decide to sell out is P cap T plus 1. Obviously, you don't have perfect information, and that's why these expectations come into play. So these, you have done expected utility and certainty equivalent in your microeconomics courses. So please do, it's covered in the slides as well. Let me quickly show you where they are. And So the subjective certainty equivalent is defined as that amount which, if investor is given with certainty, gives the same utility as the risky variable y. So y is the risky variable. CEI is the certainty equivalent for investor I, because remember, risk preferences are subjective, or depend on your individual attitudes to risk. Your attitude to risk might be quite different from mine. So it is the solution to this equation, but the utility of the certainty equivalent of I is equal to the expected utility of this uncertainty, uncertain outcome. So then the certainty equivalent is the given by the UI inverse of the expectation of the utility I. In the in the workbook that I have, it's work file 7, you can actually see that I have actually showed how to calculate the certainty equivalent for various different utility functions. Now, going back to, so as I mentioned earlier, so deltas are the discount factors. What exactly are these discount factors? So delta I represents how much a firm or an investor I discounts the future. Okay, and you have done this, net present values. You've done this in microeconomics and macroeconomics. So I'm not going to spend too much time on it, except that it can be represented as a function of these two variables. PI divided by 1 plus RI. PI is the probability of survival into the next period. Okay, for instance, 1 minus PI is the probability that a firm will go bankrupt or just exit the market by the next interaction. So Coca-Cola's P is close to 1, but Tesla, there is always a significantly high probability that Tesla will just not survive into the next period. Okay, and that's where we later on we talk about how the fixed income securities, the debt of a particular firm, is much more dependent on this PI than, and so there is a fixed income security has first claim on a firm going bankrupt. It doesn't have a stake in the upside of a firm, whereas the equity of a firm has a stake in the upside of a firm. But if the firm goes bankrupt, equity holders essentially might be left with nothing. And that is what gets us to the RI, is the appropriate cost of capital. What we usually use is the weighted average cost of capital. So, and we will talk about this in gory detail later on. A firm can essentially finance itself in two different ways. Essentially, there is a huge amount of variation between using equity and using debt, and this weighted. So, if the weighted average cost of capital is the weighted average of the cost of using equity to finance itself and the cost of using debt to finance itself. All right, we are going to talk about this discount factor in a lot of detail when we do more advanced models. All right, so let's pause at the, pause now, and I will, I have posted on Blackboard the questions that you need to answer this week and comment on your peers' answers. You need to recreate all the files that I've gone through today that are posted on Blackboard. Download all the files, go through the same analyses, go through it for different but comparable sets of securities, do everything that I've talked about, calculating the returns, market caps, do the VLOOKUPs to compare them against each other, calculate the summary statistics, means, volatilities, covariances, all of that. Then, look at the volatilities for equal weighted portfolios, calculate then the volatility minimizing weights of portfolios. You need to do that. And finally, look at the various utility maximization that we have done for quadratic utilities. But it's pretty straightforward to do it for the other utility functions as well. So I will urge you to do that as well. All right, well, thank you all very much. I will post this video on the cloud at exactly the link I had sent you before very shortly. Hope you all have a great week, and I will look forward to talking with you soon. Take care.